Now we will look at the issues related to the financing activity of the cash flow statement. So in this activity, we look at how cash inflow and outflow they are generated through the financial decision taken by the company. And simply, if I am going to look at the data source, so data source for the preparation of this activity is P&L and balance sheet. So if we talk about the balance sheet, what I am supposed to look at from the balance sheet or taken out from the balance sheet. So that is your non-current liability and reserve surplus and equity related issues. They are supposed to be covered in this activity. And another source of data is P&L account, where interest paid and dividend paid related issues, roughly they are supposed to be taken from the P&L. So roughly two data source they are there, P&L and balance sheet. Now, if I look back to the operating and investment activity, there again in these two activities, P&L and balance sheet was the data source. But in operating activity, data source for the balance sheet, which is the main component. So for that data source, which is balance sheet, we were taking current asset and current liability. In investment activity, again, data source was balance sheet, but we were taking only non-current assets. Now, in this activity, which is financing activity, we are taking data source as balance sheet, but we are taking the issues related to the reserve surplus, equity, debt, and roughly non-current liability kind of issues, including the long-term debt, etc. So when we are going to prepare, we are just comparing the non-current liability, equity, and reserve surplus related issues sitting in the balance sheet, how they are increasing or decreasing. So, for example, long-term loan they are increasing, that is cash inflow, and long-term debt they are decreasing in this year, they are cash outflow. The same thing will happen with the equity and all. So the table which I suggested should be referred apart from P&L and balance sheet is table number C, which is related to equity or reserve surplus or non-current liability related issues, where if I am not able to take my decision, then the T format of that table number C will be reported like opening will be right side and closing will be left side. Left side we write plus and right side we write minus. And I am taking the total of left and right side. Whatever is higher will be considered as a final output of that particular item sitting in the non-current liability of the balance sheet. So plus outcome is cash inflow and minus outcome is cash outflow. And two more item from the P&L item or P&L account we are taking, they are interest paid and dividend paid. So they are the minus figure sitting in this activity. Whatever interest paid and dividend paid, they're given in the P&L account of the current year. And obviously, this interest paid will be reclassified in operating activity as a positive figure. So we are referring the table number D, which says like there are roughly 7 items they are supposed to be reclassified. So what is the objective of reclassification? This is just to nullify the effect of some revenue and expenses, cash revenue and cash expenses, so that they should not be counted 2 times, right? So when we are going to nullify, let's say for example, interest paid. So interest paid, we are reporting in the financing activity as a negative figure. But at the same time, if the same figure I am writing in the operating activity as a positive figure, I'm going to nullify the effect. So nullify the effect or reclassification is nothing but to to ignore the item which is going to be counted 2 times. So roughly I am going to, or basically I am going to nullify the effect of the items which is going to be reflected 2 times. So if minus is given, I will be reporting as plus. If plus is given, I will be reporting as minus. Now, when we talk about the dividend paid in the financing activity, Dividend paid cannot be reclassified in the operating activity. Why? Because operating activity they are started with the PAT, not with the retained earning. So what is the funda of the reclassification? We are going to reclassify the seven items or roughly seven items. So they are the items they comes before the PAT and they are being reclassified. Any item which is going to come after the PAT, likewise dividend paid. So this kind of item they are not supposed to be reclassified. So idea is like why I am going to reclassify because there were some certain kind of interest received, dividend received, and interest paid, and depreciation, and amortization, and gain on sale of asset, and loss on sale of asset. So there are roughly seven items. They are already reported in the P&L account before the PAT. And when I am making this journey of the preparation of the operating, financing, and investment activity, knowingly, unknowingly, there are some certain items I am writing two times. So they will have impact on my net cash effect, right? And that is the reason I am supposed to reclassify these items so that they should not be counted two times, right? So to understand the reclassification, I will be taking help of table number D. So anyway, when I am going to conclude the financing activity, I will be getting either positive or negative outcome. So I will be appreciating if outcome is going to be positive, right? Which is a kind of indication of financial strength of the company, right? So the cost of capital which you are paying in the name of dividend paid and interest paid, they are roughly the lowest component if you're comparing with the equity and debt related changes, right? So mathematically, expected outcome is supposed to be positive, and if this activity is reported positive, then company is as a beginner, I will be able to comment yes, company is considering or company is considered as a positive company in terms of financial activities. Okay, thank you.